are you viewing the regulatory environment right now in China? And there's some that are saying, look, this is just an ESG effort, the moral hazard issue that has been long and coming. And some saying, look, China is uninvestable. Where do you stand?
Well, it's pretty confusing for all of us, particularly since what's driving it is politics more than economics, and predicting the politics is very tough. But there's a real debate among policymakers and policy advisors within Beijing about the direction they should go. Because at the same time that we've been hearing for the last several years rumors of more control, we've also been hearing that they want to make the economy resources allocated more by the market. So there's a conflict here, and it's really hard to figure out which way we're going to go. But I think the thing that we've learned, which we should have always known, is that the Chinese markets are quite different, and you have to think about them much more politically, much more different than you do other markets.
And it brings to mind then, Michael, this 4-decade span of opening up the economy and letting animal spirits and capitalist spirits go. In some way, do you think this is what's happening recently? Is Beijing trying to rein some of that in? That it's just gotten, a little bit too much, let's say, in certain parts. Say the education sector, say private equity in funding property, for example, are two very recent examples.
I think that's right, and I think there's sort of a deeper concern running here, and that is that the Chinese growth model has relied, as you know, very heavily on investment, which itself has relied very heavily on debt. And as China began increasingly to overinvest in non-productive projects, as it has in the last 10 to 15 years, one of the consequences has been an explosion in the country's debt burden. The debt to GDP ratio has really taken off. And so there is, you mentioned moral hazard earlier on. There are parts within the regulatory groups that are very determined to eliminate moral hazard and to prevent the growth in debt. The problem is that the whole growth model depends very heavily on moral hazard and on the expansion of debt in order to deliver the high GDP growth rates that Beijing wants. I think anything above 2 or 3 percentage points requires a rapid increase in debt. And it's not really clear how this is going to fall out, because you've got these two completely incompatible aims. One is to bring debt under control, and the other is to keep growth rates high in order to sort of bulldoze through the various problems facing the economy. But you can't do both. It's one or the other.
But isn't what they're doing right now then the correct way to go? And I would argue, because you're trying to get away from a debt-fueled infrastructure government spending model to consumption-based model, then you simply transfer that money back from local governments and these big firms, for example, back to the pockets of the middle class. Right.
But that's politically very tough to do. It's always been the toughest thing to do. Imagine households retain roughly 50% of GDP, and governments roughly 25%, and businesses roughly 25%, broadly speaking, because it's hard to distinguish between business and government. But imagine what those transfers require if you want China not to become a normal country in terms of consumption, but just to get halfway to normalcy. You would need to transfer at least 10 to 12 percentage points of GDP from probably the government sector to the household sector. So we go from households of 50 to households of 60 to 65% of GDP, and governments of 25 to roughly 5 to 10% of GDP. And what I would argue is that that implies a huge political transformation, one in which households retain twice as much as government, into a system in which households retain 6 times as much as government. So I can say the arithmetic is easy. It's the politics that are the really, really hard part of all of this.
And Michael, some say, the whole crackdown on the technology sector, given it's such a significant portion of growth, that this is not just about putting a risk premium on the stocks. It has actually growth implications and potentially could weigh on growth. You're saying still your outlook is that China could still lean towards the 8% growth versus 6%. Why?
Well, I've always had a much lower growth target than I think the rest of the market. The consensus is 8 to 9%, and I always thought it was going to be on either side of 7%. Below 7% of those who are really concerned about debt have the upper hand, and above 7% of those who are more worried about growth have the upper hand. But China can continue, as long as it has debt capacity, it can get any GDP growth rate at once. These are not real GDP growth rates. They're generated by a lot of non-productive activity. And as long as you have debt capacity, you can have as much non-productive activity as you want. So the real issue is how much debt are they willing to tolerate? And I think those concerned about debt had the upper hand in the beginning of the year. But you'll notice that growth rates have been slowing quite significantly. And so my expectation is that in the second half of the year, we're going to see them step a little bit more on the investment accelerator, and we'll see growth levels pick up. So my guess is we're probably going to get around 7.5% growth this year. But it's such a political target that I always caution people that if the politics change, then expect the GDP growth number to change.
Michael, real quickly, I just got a viewer question that I want to ask you. They're asking, what is the most important driver of Hong Kong and China stocks right now? Is it simply down to liquidity measures?
Unfortunately, I don't follow Hong Kong closely enough to really be able to give you an intelligent answer there, Yvonne.
Okay. China stocks, though, or everyone's talking about what's been going on with the PBOC, that we might be seeing some more liquidity coming in. What was your outlook on that?
I think will be. I think we will see an expansion of liquidity because I think a lot of the numbers have been pretty weak. I think there's the withdrawal of foreign investors in the last couple of weeks from the Chinese stock markets. By the way, I think that's a good thing. I think one of the things that China really had to worry about, and it wasn't worried about enough, was that foreign inflows coming into the stock and bond markets it's still quite low overall, but they're rising very, very quickly. And that creates a big problem for Chinese currency policy and monetary policy. And they've been trying to counter that by encouraging outflows, but that's not been very successful either. So I think a slowdown of foreign inflows into Chinese stocks and bond markets is actually pretty good for China and should be a sign of confidence. I tell my clients that when the numbers are really high, then they shouldn't be coming in. And when the numbers are very low, that's a much more interesting time to come in because significant inflows undermine stability within the market.